There are so many amazing tax strategies in real estate that you can use to your advantage to take your portfolio to the next level and save you thousands of dollars. But just because a tactic exists doesn't mean it will work for you. Today, we're going to discuss adding your child to your home's title. There's a reason for it, I promise. Will this be a tool that works for your investment portfolio? Let's find out. Hi, everybody. My name is Mindy Jensen, and I'm the host of the BiggerPockets Money Podcast. And I am so excited to have Natalie Kolodij on today. She is a tax expert and real estate investor, and she's the one who told me about this neat little tip. So there couldn't be a better resource for me to have on. Natalie, thank you so much for joining me today.
Yeah. Hi, Mindy. Thanks so much for having me.
Okay, before we get into this topic, I want to make it super clear that this isn't for a rookie real estate investor, and it isn't a tactic that all investors are going to be able to take advantage of. This specific tactic is because I am about to have to pay taxes, and I'd rather not. Now, I am all for paying taxes if I have to. I want the government to run. I like having a police department and a fire department and all the things the taxes pay for, but I don't want to pay any extra taxes if I don't have to. And there is this section of the tax codes called Section 121 that allows you to exclude up to $250,000 if you're single or $500,000 if you're married. Well, that was the conventional wisdom. So I was recording with Natalie at BPCon, and I was excited that I was going to finally have to pay some taxes on my flip, because that means I have made more than $500,000. Yay, me. And then Natalie said, Natalie, what'd you tell me?
I said you might not have to do that because this is something that aligns with what you were thinking about doing anyway.
So let's talk about this. I just said that you don't pay taxes on the gain of your primary residence, and I'm doing live-in flips as my primary strategy for investing in real estate. I said you don't have to pay taxes on $250,000 if you're single or $500,000 if you're married. And you told me, no. It's $250,000 per person on title. So if there's one person on title, it's $250,000. If there's two people, it's $500,000. If there's three people, it's $750,000. And that's when you piqued my interest.
Yeah, absolutely. I think historically we've always heard $250,000 single, $500,000 married. And that's not the case as a whole. The nuance to being married is if you're married, only one person has to meet the ownership test. Normally, you have to own and occupy for 2 out of 5 years. If two people are married and filing jointly, only one person has to have owned it for at least 2 years, but both have to have occupied it. And this is really common when couples move in together and then they sell off one of the houses. So that's kind of where we got this $250,000 single, $500,000 married. But unrelated to that, just if multiple people co-own and cohabitate in a house for at least 2 years, each individual qualifying person is entitled to their own $250,000 exclusion.
You just said the Q word. You said qualifying. What does qualifying mean?
Yeah, so qualifying means they are someone who legally owns the property and that it is their principal home residence for that 2-year mark. And important to note, too, that ownership and occupancy requirement isn't 2 years like 2 calendar years or 2 tax return years. It is 365 days times 2. So make sure you're not shy by 3 days or you lose it all. So you have to hit that mark.
That is a really good point. And I have done flips in the past where I'm like, I can't sell before this date. And I don't know if the IRS takes this into account or not, but I even look to see if a leap year was encompassed in that. I add another day. I am not risking all of my $500,000 of no taxes for one day.
Yeah, it's not worth it. Put an extra week or 2 in there. Just cover it just in case.
Yes, absolutely. So this is really, really interesting because I have a house that I bought for $365,000. The same house, it's a cookie cutter neighborhood, the same house around the corner sold a year ago for $850,000. Now, those of you who are sitting there doing math are thinking, well, but you put some money into it, right? I did. but I'm also not ready to sell. And I'm probably not going to sell for a couple of years. So I am very realistically going to be hitting up against that $500,000 limit. Now, remember back in 2022 when the real estate market just went absolutely bonkers and housing price, like I watched prices go up every single week. So if we hit that again, I could be looking at several, let's see, how many dollars? Even if I had to pay taxes on $100,000 because I didn't add my daughter to my title, those are taxes I'd rather not pay. So Natalie, what is the process of getting my daughter on title? Do I just say, bam, she's on title?
Yeah, so you just have to legally gift them a portion of the house. They have to legally own part of this. So that's part of the nuance to this, is that they do have to be a legal owner. So my advice is only on the tax side. So one of the biggest things I will say is check with your state and an attorney in your state to see what the laws are regarding a minor being on title, being able to execute a contract, and all of that good stuff. In some states, I even know that if you sell a property, like there's certain states where if you sell a house and there is a minor on title, the title company or state can appoint them a guardian for their interest because they're not 18 and can't execute on their own yet. So you just want to check with what the legal impacts are going to be before you look at this. But otherwise, the first step is just having them be added to title as a legal owner because they're likely already occupying the house with you.
So this is where my specific situation gets interesting. I have two daughters. One of them is 14, but one of them is 17, turning 18 early next year. So because she would have to own it for 2 years, meaning be on title for 2 years, I could put her on title now. And then by the time we go to sell it, she will be, what's the opposite of a minor? An adult. Like she will be a major. She will be an adult and therefore can sign it and we don't have to deal with this guardianship. But that's a really good point because if I start getting inklings in my area that my house is going to be worth even more than $750,000 over what I paid for it, I've got another kid I can add to title, but then that resets the clock for another 2 years. I want to make sure that everybody listening understands they still have to be on title for 2 years, right?
Yep, there does have to be 2 years of ownership. But this is something we talked about was the ownership and occupancy don't have to be at the same time. So this is kind of the perfect scenario is where I've seen this work with taxpayers and why I brought it up with you when we were chatting, Mindy, is a couple that has a child who's getting ready to go to college. So things that are happening anyway are they now need money for college. The people are downsizing their house anyway, and that child is moving away. So as a combination, adding them to title allows all three things to still happen, but with a tax benefit tacked on.
I love that. Now, the rule for Section 121 is you must live in it and own it for 2 of the last 5 years. But there's a nuance for veterans. Isn't that correct?
If someone is active duty, so if you are like not using the home because you're active duty military, then there is a maximum of 10-year extra within that look back window. So instead of 2 out of the most recent 5, it bumps out to 15 years.
Oh, it's 10 years more. Oh my goodness. Okay. So active duty doesn't apply to me, but if you are listening and you're active duty, maybe you might want to hold on to that property. Now, can they as active duty live in the property and then move out and rent it while they're going someplace else and then move back in to satisfy that 2-year period?
Kind of. So there is a nuance to Section 121, and that's called non-qualified use. So any time that a primary home isn't used as a primary home, those years are non-qualified use years, and that just means that when you would sell, a portion of the gain would be taxable for that number of years. So if you rent a house for 10 years and then just move into it for 2, those 10 years out of 12, 10/12ths of your gain will still be taxable. There's an exception to that, which is, I know, right? So any time that is after the most recent time you used it as your primary home does not count as non-qualified use. So this means that once you move out, you've got this 3-year window that you can rent the house. And when you sell, it would still fully qualify because you're in a 5-year look back. You've occupied for 2, and you can rent for that other 3. But it has to be after that most recent time you lived in it, not before.
Okay. Now let's really dive into it. I live in it for however many number of years. I rent it for 4 years. Can I move back in for 1 year and have that same qualified nuance?
Yeah. You would still need to hit that 2-year mark again, because you still have to get that 2 years at any point to reach the level of the exclusion. You need that 2 years. But then looking back, it's still based on a ratio, but because those 4 years are before your most recent use, they're still non-qualified. But the ratio would be those 4 years out of the total amount of years you owned it. So out of the prior years and the later years.
Okay, so it sounds like if I'm not moving into this property and living in it for at least 2 years and then immediately selling it, I would benefit from having a chat with a tax professional to make sure that I am hitting all of these marks if I am going to try this out, try to sell under this particular Section 121. Because like we said in the beginning, if you miss it by even a day, the whole thing is gone. You don't want to make a mistake when you're doing this. What sort of tax professional can help me out? Is this any kind of tax professional, or should I talk to somebody who is specializing in real estate?
Yeah, I would say as an overview, someone who is a licensed professional, an EA or a CPA, should be able to help you with this. This specific strategy is pretty particular to real estate, so I would strongly recommend finding someone specialized in that who's a real estate tax strategist. Just because of the nuances associated with this, you want to make sure nothing is overlooked.
Are there any circumstances that would make this have a negative impact in my home ownership and sale?
Yeah, I can think of a few things. So they're not necessarily negative, but more cautions, right? With any kind of a tax strategy, there's always really good reasons to do it, but those same really good reasons can be horrible for someone else. So one of the big things to be mindful here is that the person who is also the owner has to get their portion of the gain. So what we can't do is just circumvent, by putting someone on title or someone getting money and then handing it back to you, because when it sells, each person has their amount. So there might need to be a gift tax return filed or something of that nature. We don't want to just claim that, but then only one owner gets all of the actual proceeds. So we still have to kind of file or follow this execution trail.
That is a good point. And honestly, I don't mind giving my daughter some of this tax savings, because while I said I don't mind paying my taxes, I think I am a better steward of my money, and my daughter is a better steward of my money than the government is. So I'm happy to share that with her. But that's a good point. Let's go to the other end of the spectrum. Let's say that someone is living in a house with their partner and their partner passes away. How long do they have to sell the house and still get this exclusion with both people on title?
Yeah, you've got 2 years after they pass to still file and receive the $500,000 amount instead of it dropping off to just the $250,000. But if both people did own the property, when one of the two passes, the other spouse receives a stepped-up basis, where basically half of the value of the house now increases to whatever it is on that date of death. And if you're in a community property state, it's actually a 100% stepped-up basis. So if that happens either way, you might not even need the exclusion, because you might technically not have gain on your sale if you get that full step up.
Ooh. Okay, so if you are thinking about selling your house and it is your primary residence or has been your primary residence in the past, look into Section 121 exclusions and make sure that you are hitting everything before you put it on the market and before you sell. All right, there you have it. Thank you so much for watching this video. I hope that this content helps you start thinking about ways to think outside the box. A good real estate tax strategist can help you with even more ideas of thinking outside the box. Natalie, thank you so much for joining me today. Where can people find you?
Yeah, absolutely. The easiest way to find me is just natalie.tax is my main website, and everything is linked to there.
That is fantastic. All right. And Natalie and I are both all over BiggerPockets. So if you are in the BiggerPockets forums, give us a shout out. If you like this video, please give us a thumbs up and don't forget to subscribe to this channel for more videos just like this. This is Mindy Jensen signing off.